Hey guys, it's Downtown Josh Brown, and welcome to an all-new edition of What Are Your Thoughts? Here with Michael Batnick, as always, and I don't really know what he wants to talk about today, and he doesn't know what I'm going to ask him about. It's our favorite game. Play along with us in the comments below. Let's get into it. Mike, you wrote maybe one of your best blog posts of the year, and I read it last night. I know it's from a couple days ago, but I feel like this concept of all the different market environments we're experiencing all at once is a really interesting way to think about how history sometimes repeats itself. So I just want to give away the hook here because I think that's important. You're basically saying 2020 is unlike anything we've ever experienced. This year has included some versions of the following. And then you're going through the income inequality of the Gilded Age, the election of 1896, the pandemic of 1918, the stock market of 87, the housing market of 06, and all of those things are true, and we're having them all at once.
Anything I missed?
Maybe. The social movements of the 1960s, the speculation of 99. At first, I was thinking, isn't every year have a little bit of elements of, not really. I think you really nailed something special about 2020. It's almost like a mashup, like a DJ throwing in samples from like every one of your favorite songs. I think it's so apt. What made that occur to you?
I don't remember where the seed of this idea came from, but you know what's really messed up? It's only September 1st or 2nd.
I know. What the hell?
We still have another third of the year to go.
What haven't we experienced yet? I can't even.
But here's another thing. Like, this is happening to all of us, but everybody's situation is so different. There are like, I guess, 100 different variations of how people are living these days, and so, I mean, just
what does that mean? You mean,
like, for example, I consider myself to be like the most fortunate person in this time right now. I've got 2 young children at home. I have one of them is a baby that I've gotten to spend more time with than I otherwise would have been able to. Obviously, I'm in my home office. I have no worries. I am like in the 0.00001% of good fortune right now. This has been some of the best days of my life.
Okay.
And then obviously you have other people that are struggling to put food on the table.
Yeah.
And then everything in between.
Yeah. So let's say like you're a roadie for a band, or like you work for Lollapalooza assembling the stage or whatever. You spent the whole year basically doing nothing, and it wasn't your fault. Like, unless you took a different job in a different industry, this is your version of the Great Depression.
And then imagine that person wakes up every day with nothing to look forward to.
Yeah.
Just nothing but struggle. And then, of course, the social movement stuff and people that are sick and died.
Yeah.
So there's just such a wide spectrum of how people have experienced this year. Some people are going to look back on it fondly, some as a nightmare, and everything in between, like I said.
I had a version of that. Like, I was in Maine last week on vacation with my family. I've never been up there before. And every single person I talk to that works in the tourism or travel industry, they're like, I've never been busier. Like, so we look at travel and we say, oh, that industry's screwed. They're dead. No, it's not. It's not like that. It's more nuanced than that. It's tourism in big cities that's dead. New York City tourism is dead. You go up to Maine, the guy we chartered a fishing boat from, he's like, I need 5 boats to deal with all the demand. The guy that ran the bicycle tour around Portland, Maine, he's like, if I just had unlimited energy, I could do 12 of these a day. Like, because that's how many people are coming. So I think it's more nuanced than we think. But yeah, to some degree, these different years and these different experiences. Think about housing market. When was the last time America had a recession that coincided with a housing boom? It's like insane. It's like insanity.
Every year is like this, and we always see the world through our own eyes. But this has to be like the most personal year ever.
Right. Okay. What do you got?
I want to talk about the put-call ratio, which is basically as low as it gets. So what this measures is every put divided by every call. So if it's 1, then for every put call there's a call that's
so
as well.
People that are buying puts are opening up a bearish bet on a stock or an index. People who are buying a call are expressing bullishness. So the put call ratio is measuring the aggregate amount of risk appetite or fear versus greed in the market. And
So-
the put call ratio you're saying is pretty much at an all-time low.
It's close. It's close. So there's been some talk about this over the years. Is this still really representative? There's VIX products. There's other ETFs where you can express bearishness. You don't necessarily need to buy options anymore. Whatever. I think generally speaking, this does a fairly decent job. Nate Garassi tweeted yesterday, stat of the day, across the U.S. exchanges last week, traders bought a record 22 million more calls than puts. Again, within the context of a pandemic, an economy that is not exploding, but you've got speculation absolutely going through the roof right now. I don't think there's any other way to put it. I don't want to say there's a bubble that needs to pop, but there is absolute euphoria right now.
Well, let me put it to you this way, though. It's earnings season for some, and you've got reports coming out like what Salesforce.
It was happening prior to this. Like if you look at like a 1 month moving average, for example, it's been crashing.
Oh, no, I understand. I'm just pointing out that that's the winning trade. I mean, it's working. It's not like it's happening in a vacuum and all of a sudden people are bullish and it's unjustified. Every single time they've bought calls going into a big time earnings report over the last 2 months, it's been the right trade. Pick
well,
a
to
stock.
that point, if you understand anything about human behavior, you could easily make the case that this is rational. Every morning you wake up and the futures are up. Why wouldn't people be buying calls? It seems like free money.
But forget about what the market's doing. Look at what corporations from Home Depot to Salesforce and everything in between, look what they're telling you about what's going on.
I think it's more markets and businesses, frankly. I think people are buying options.
I don't agree, because what's the options activity? What's the options activity in hotel stocks? It's probably nowhere near what it is in software as a service stocks.
My point is, people that are buying options are I'm not using this pejoratively, but they're gambling. So they don't care about the underlying businesses. They're looking at price, and price is going up.
Yeah, but I think they're being discerning because they're probably trading these things into earnings to some extent, like at least recently. That might not be the case a month from now when they're
anyway. I got to admit, I'm jealous.
Why?
Like back in my day,
you should, as soon as you should start buying. You should start buying weekly options. The market will be down 7,000 points.
There was nothing more adrenaline inducing than buying weekly options. Nothing.
I just don't get it.
You're old.
No, I never did. I never got adrenaline from that.
Well, you're not an adrenaline junkie. You're like very conservative that way.
No, I'm the opposite. I like to buy a stock and then like 10 years later, look how much I'm up. And that's,
I like to buy a weekly option 30 seconds before it reports earnings on Thursday night.
That's a mindset thing. All right. I want to get into Zoom. Speaking of euphoria, so Zoom now has a $130 billion market cap. It's worth more than IBM on the public markets. Barron's had a piece looking at that. It's a 10-year-old company. It was founded in 2011. Full disclosure, I'm a shareholder. I don't care if you buy it or sell it. I don't give advice on this video, but I own it. So it was conventionally overvalued this spring at $20 billion market cap. I'm sure it was selling 50 times sales or whatever. But the market was right. So this company comes out and they tell you that in the second quarter, April, May, June, they earned, not revenue, earned more in profit than they earned the entirety of 2019. Hundreds of thousands of corporate customers, millions of individual customers. Doesn't the market just sometimes get it right by overpaying substantially for a situation like this? Like, isn't that a fair thing to say?
Yes. What? Now let me give you the Enron case here.
Okay.
I'm just kidding.
No, I feel like that's a part of the story when people just look at a stock and they go, "Oh, it's overvalued." Relative to what? Like relative to the price you want to pay?
Hang on. Let's make a distinction here. So we were talking about this where take a company like Apple, for example. You've got a fairly mature business model. Now, all to their credit, they've reinvented themselves several times over, but their revenue and their net income is fairly stable. It's up double digits, but like in the low teens, okay? And then you have the multiple or just the PE for whatever, use that as a metric, going vertical, where it was trading in a range, now the PE is going vertical. To me, that is hard to wrap my head around. However, to your point, a company like Zoom that reported revenue growth of 355%, yeah, that could trade at a multiple of infinity because who knows what the future looks like. At least you're paying for explosive growth. Something like Apple, I don't really get. Tesla, forget about it. Tesla is trading at, I know you could have made this case about Amazon, but Amazon's the best stock of all time. So I don't think that we should even be going down that road. Tesla is trading at 1,300 times earnings. So if Tesla had a net income of $1,000, you're paying $1.3 million for that.
Yeah. So now you say, well, that doesn't mean that just buying an overvalued stock is going to work. So people would be like, oh, so what should I do? Buy the biggest bubble stuff? No, just understand why they got that way. Like, there is a reason that people were paying 20 times sales for Zoom in April, and that reason manifested itself in real life results. And it's not
Correct.
just a revenue story. They're earning a ton of money.
However, can we also say that on average, if you are buying stocks that are trading at insane valuations, on average, you're taking a lot more risk. Some of those will pay off, obviously, like at the Amazons of the world.
Okay,
but generally speaking, that's a really bad strategy that is working wonderfully in 2020.
Are you taking more risk paying 30 times earnings or above for
30 is not a lot.
Okay, 50 times earnings or above for companies that are growing by 50%? Are you taking more risk doing that than you are paying 12 times earnings for a company in an industry that's literally going away? I don't think so. I don't see it that way. I don't see it that way. Like, you want to buy a steel stock at 6 times earnings? You can. I think there's one left. You know what I'm saying? Like, I don't understand why that's perceived as being riskier. I understand you don't have the margin of safety, but you have a different you have a different margin. You have a company that's growing like crazy and attracting investment capital.
And attracting competition. So that was one of the knocks on Zoom.
Not in the age of network effects, though. Not to the extent that you think.
What does Zoom have that's so special? They basically do what Skype does, but better.
So that's what
They're not the only player.
That's what I thought. But you know what? They said that about.
So we were wrong.
They said that about Netflix in 2005. What do you mean streaming? Like, what do you mean DVDs? There's Blockbuster. Right. They said it about Netflix in 2012 when they were going to go international. There's going to be competition. Well, guess what? There's competition, and Netflix is still the best, right? Netflix all-time highs. So I don't buy that. There's nothing special at all about Zoom, and it's a complete commodity.
Well, from a product point of view, what I mean, we're on Zoom right now. But what does Zoom do that's so spectacular? By the way, I don't know. It's pretty good.
I don't know. They have 1,000 corporations paying them more than 6 figures a year. So it's clearly better than WebEx for those corporate. Those are customers that could very easily pick up the phone and pay Cisco instead, and they choose not to. Blew the doors off Skype. Embarrassed Microsoft and Cisco this year. There's something about the interface, and now the fact that Zoom has become a verb. It's a colloquialism. We talk about Zooming each other. You ever tell somebody, I'll f***ing WebEx you? No, nobody says that. So whatever it is, they have that thing, and it's not magic. It's actual business. They're making money. All right, what do you got?
By the way, Tesla's going to be worth more than Berkshire in like 2 days. So happy 2020. Okay. Nick Majuli did this post on Robinhood Traders, looking at the data side of it, and he put together one of the most chef's kiss charts I've ever seen. It was least to most correlated stocks based on Robinhood activity. And not surprisingly, the ones that were more correlated when you had more activity on Robinhood that drove prices higher, although just because there's correlation doesn't mean that there's causation, but in this case, I think there probably is, were the small names, Kodak and Nikola, for example, with tiny market caps. The ones that were least correlated were Starbucks and Google, Apple's Apple, Amazon, even Tesla. Really, there's really nothing there.
So what he did was totally intuitive. Like, I would have predicted the outcome, but he proved it. So he's basically saying this whole Robinhood effect, market caps of $5 billion and under, Robinhood could absolutely move these stocks over the course of a week or two. They can't move stocks on that platform for 3 years, and they're not moving Google. I could have told you that, but I'm glad he did it because I think there's so much misinformation about like the next generation of traders and what they're doing to the market. They ain't doing much. They're just playing. They're probably in the options market.
But this is nuts. Citadel reported that retail traders on some days make up nearly 25% of stock market activity. Yeah. Holy moly.
Well,
that's not nothing.
Listen, this is the new reality, and they'll keep doing it until we have a 2-year bear market, and they'll get bored and they'll move on to the next thing. Maybe it'll be fantasy
but
drafts and sports and online sports betting.
But in a bear market, don't you think they're just going to find the triple levered inverse ETFs and go nuts?
I saw them do that, but that's not the majority. The majority get wiped out and don't come back.
That's true.
And then you have that hardcore percentage that are like, oh, I'll just play them on the way down now. I'll just short everything. So yeah. You're right, but it won't be the bulk of the new the bulk of the new investors are going to be in like these electric truck companies, and they're going to lose 90% of their money, and they're going to be on margin, or it'll be an option, so it'll happen fast. It'll happen in like a month, and they will not be back. But then you'll get like a kernel of that populace will become real investors, and those lessons will have been helpful for them because there's not a lot of money that they're betting with. All right, I want to talk about Seth Klarman and Baupost. So Liana Orr, let me just say this. I read everything she writes at Institutional Investor magazine. She's terrific. She does a really good job at getting people to talk. And this is the first time I've ever seen a piece of journalism where investors were willing to be like, no, I'm not that impressed by Klarman. He's like, it's like almost like insulting God in our business. And they're not insulting him personally. They're just like, he lost his touch and or he doesn't really care. He's not willing to take any risk anymore because he's too rich. His fund's too big, or he's wrong and he won't reverse himself. Like some version of why he doesn't make anyone money anymore. He hasn't had a double-digit performance year, or he's only had one double-digit year of performance in 10 years.
That's rough.
He's carrying a third of his portfolio in cash and charging 1.25 and 20.
Apparently, his heavy cash position is just sort of how he does it. But she got, to your point, she got like 10 investors to speak off the record.
Well, that's what I want to ask you. So what are your thoughts? Every one of these quotes is the perfect performance chaser quote. And it makes me, it's confirmation bias for me that all of this fund of hedge fund stuff and hedge fund consulting stuff is just nonsense. They're the same. It's the same personality traits that individual investors have. And they just dress it up. It's more sophisticated. Can I read you a couple of these?
Go ahead.
Even though we have terribly high regard for Seth, these are all anonymous investors because they're all cowards or they'll get fired. This isn't what we want. Performance is slipping. The strategy changed. You don't even know what the strategy is. Klarman's strategy is whatever he says it is. All right? So the strategy didn't change. You're just not making money in the fund, and you're tired of answering to your clients about why. Do you agree with me on that?
Well, it does sound like he's doing a lot more private real estate stuff, so maybe it did a little. But to your second point, what are these consultants supposed to say other than what they're saying?
Right. Well,
it's been a decade.
Yeah. Hold on. This is great. I see Baupost's fate playing out. This is true. I agree with this one. I see Baupost's fate playing out over the next 5 to 10 years. This is a $30 billion fund. Quote, if there is a distressed cycle and they make good use of it, they'll be twice as big in 10 years. If things continue as they are, they'll leak assets and be half the size, a quarter of the size in 5 years. I totally agree with that. If all of a sudden we have this like depression environment and the bears end up being right and Klarman actually starts putting this money to work, he'll be $100 billion. He'll be like the next Bridgewater. But that's
anybody that has any sort of value bent has had a really, really rough decade, and he is like the godfather of modern day value investing. So
yeah. So I said this last week. Just be a private family office. What's the point? What do you need? If you're Seth Klarman,
by the way,
what do you need this shit for?
I think in 2010 or 2011 there was an article in the Journal where he was like very, very much beating against, I think, the Fed and saying how like bad returns are going to be.
He did it 2 months ago. He did it.
But I'm saying it was 2010 that he first did this. I believe.
It's the same thing for 10 years. He's not.
But anyway,
trading.
it's not just him. It's everybody that's in this cohort. It's been a tough decade. It doesn't mean that it's permanent. But if you're a consultant, you can't die on this hill forever.
Oh, they will. He's one of the guys that they'll die on the hill for, and they will, because they've probably said too much over 10 years, convincing people to hold on. They have the same problem he has. They can't reverse themselves. So maybe they'll get bailed out. All right, what do you got?
By the way, I forgot to ask you this. Why in the world was Ford consistently one of the most popular stocks on Robinhood? Could you explain that?
Because it's $6 and people don't understand that the price of a stock doesn't dictate whether or not it's cheap or expensive.
I think that's it. All right.
It's not. It's not. These people literally have.
I was
they're
thinking
like,
about this yesterday.
Wow,
I was like,
Ford is single
Ford?
digits.
Yeah.
They literally
$4 to $6. That's a steal. Okay.
You could
You're
make
right.
you could make the argument that there's some excitement about the Bronco, which I do think is going to be a hot release. I don't think that's going to turn the shares of Ford into Tesla.
Forget it. No,
But-
you're thinking too much into it. But by the way, how sick is that? That people that are buying Ford because it's $6 a share and it seems cheap are destroying professional investors like Klarman and other professionals. Like that's how hard investing is. Of course it's temporary.
and it's temporary.
I'm just saying it's nuts. Of course
agree.
it's temporary.
Okay, what do you got?
All right. We got some Dow replacements. So because Apple split, they had to shake it up because it's a price weighted index.
Right.
So we've got Exxon, Pfizer, and Raytheon coming out. By the way, Exxon coming out of the Dow.
Blows my mind.
Right?
Blows my mind. Absolutely blows my mind.
And coming
Only
in, we've got
only Chevron is left of the energy.
Yep.
It's sick.
Yep.
It's crazy. I mean, I get it. They should have done it 5 years ago, but it's bananas to me.
coming in. We've got Salesforce, Honeywell, and Amgen.
Yeah. Well,
So-
Honeywell's replacing Raytheon. I think that's M&A related. And then Salesforce is interesting because they leapfrogged Facebook and Alphabet to put it in there. I mean, it's big. It's $100 billion plus
Well,
market cap, but it's not enormous.
I wonder if that's a price thing.
I don't. Well, that's a good question. But we saw Apple do a 5-for-1 or a 7-for-1 to get into the Dow.
In 20, what year was that? 13?
13.
15?
14 or 15. But Salesforce is very interesting. Salesforce, in many ways, is really the godfather of ARR, annually repeating revenue, or annually recurring revenue. And that is what our entire economy is now built on. Benioff invented it. And corporate customers were not comfortable with it at first. They wanted to just buy a software license. Like they were accustomed to just, here's $90 million. We just want to use the tech. He really invented this. This is long before Apple was selling phones by subscription, long before Netflix became an online subscription. And he probably doesn't get enough credit. Every large market cap stock right now is doing some version of a subscription, even Disney. And Benioff really pioneered that. So there's some poetic justice in seeing Salesforce as part of the Dow.
So, Dividend Growth Investor on Twitter has a blog post where he looked at a paper that I've seen in the past, but I haven't seen it recently, called Real Dogs of the Dow. And what they did was they looked at companies that go in versus the companies that are replaced.
Sure.
And there was 50 cases between 1928 and 2005 of companies coming in, companies going out. And in 32 of the 50 cases, the deleted stock did better, which is not terribly surprising. It's a just mean reversion. Obviously, the companies that are going out because they've sucked.
The thing is, there were some companies though that things went really bad for that came out. So you don't just want to automatically buy something deleted. Wasn't Sears in the Dow?
Of course not. Let me just finish some of these stats.
Okay.
So there's a chart that we're going to show showing that from really the early on, from 1920 to 1990, companies that were removed beat the shit out of companies that came in.
That's crazy.
However, and then it broke it down by like basically the performance was like over the first 1,500 days or so, there was massive outperformance. So over the first 250 days, for example, companies that were deleted gained 19% on average versus companies that came out only gained an average of 3%.
You mean companies that were added only gained an average of 3%?
I'm sorry. That's right.
Right.
However, this paper was written in 2005, and what do you think's happened since?
I bet it's the opposite.
The exact opposite. Companies that were added, like Apple, for example, companies that were added have gone out to outperform, and I think it's pretty much simply a value growth thing.
Yeah,
like growth
it's 100%.
Growth has beat the crap out of value for the past decade and a half.
If you
or decade.
When they added Apple, there were people that were like, "Oh, remember they added Microsoft and Intel right at the top of the tech bubble?"
Of course, that was a lot.
Well, it didn't work out that way. That's why all of your stories and analogs about the past need to be taken with a grain of salt, because while there are always some repetitive elements to these things, they don't play out the way you think they're going to play out. And I think if you had bought the stocks that have been added to the Dow in the last 15 years, you've probably done really well.
Turns out that the most bullish thing over the past cycle is when you hear people say, "I remember when."
What? Just go the other way?
Pretty much. I mean, I'm being a jerk, but
yeah, you are. All right. Well, listen, guys. What do you think? What are your thoughts on these topics? We love your feedback. Tell us what your thoughts are on Dow inclusion and disinclusion. Tell us what you think about the Klarman article. If you haven't read it, we'll link to it. We love your thoughts. We love your feedback. We want you to subscribe to the channel if you haven't already. Go ahead and throw us a like. We will be back next Tuesday as regularly scheduled. Say goodbye, Mike. Nice salute.